Welcome viewers to our mine finance discussion for one-to-one mining investment Americas. I'm very pleased to be joined by a group of industry experts stretching the globe from Washington to Perth and with a wealth of experience in financing and developing mining and infrastructure projects under their belts. We're in very good hands to have a good discussion today. I'd like to introduce the panel and welcome with us Christopher Alexander, who's partner at Ibaera Capital, Neil Pereira, who's Principal Global Infrastructure and Natural Resources in the Mining Division at IFC, David Kaplan, who's the founding partner at Lascaux Resources, and Karr McCurdy, who's partner at Rock Elm Capital. Gentlemen, thanks again for joining me. We're going to be addressing the topic of finding and financing quality projects in a post-COVID-19 world, or should I say a current COVID-19 world, in fact. How have you experienced 2020 so far? And how have you continued to create value and develop projects over this quite challenging period? Perhaps I'll put this to Chris, if you could start us off, please.
Sure. Yeah, thanks very much, Adam. So obviously 2020 has been a very difficult year for everybody. In terms of our business, we specifically invest into the life cycle of mining projects around the advanced exploration stage. So from our perspective, our fund that's closed now, and the two projects we have in that fund, both of them are offshore. So one of them is in West Africa, in Ghana, which is effectively completed, and we're currently exiting that project. And the second project is started last December 19. We've been relatively fortunate, and we have teams in place in both of those regions, but we ourselves haven't been able to get out there and access those. So from that perspective, it's been quite difficult because our business is very much focused on investing into a project to obviously advance it to from that advanced exploration stage all the way through to construction, so that entire period, and not being able to add value directly, which is another one of the aspects of our business which we do very well, has been quite hard. In terms of what we've done this year to mitigate that is that we've actually turned our attention to projects locally in Western Australia. So we're fortunate enough to have a pretty expansive mining industry within our own country and specifically within our own state. So for most of this year, the last, I guess, 9 months, since around February, we've been focusing our attention on looking for projects within Western Australia, and we're quite far down the line with two of those projects specifically. Had we not been able or been fortunate enough to have projects in our backyard, then we would have found it relatively difficult to, I guess, either search and find and actually do proper due diligence on projects outside of the country. And the projects we do have would have been relatively difficult to actually progress them as fast as we'd like.
Yeah, certainly, absolutely. Okay, and is anyone else on the panel, how are you managing your portfolio? Are you experiencing similar challenges as well? And are there any sort of ways that you've come around that? David, perhaps you could take us through how the experience has been from your side.
Yeah, actually, probably similar to Chris, we were fortunate that the one project we're still working on is in Colorado, which not too far from that Karr actually knows about. And they've been lucky, and we've been able to keep working there, and then actually adding to the team. So that was just dumb luck. I think self-selecting in general, our mandate has always been very careful in terms of jurisdiction. So I think the problem is that's becoming a crowded trade now, right? Everyone wants to be in Western Australia or Southwest US, where there aren't a lot of cases and there isn't a lot of COVID. So I obviously the next round is going to be for people like Neil that are able to take on jurisdiction risk and put on insurances around that. And I don't know how the next wave of junior financing in places like Africa or Eastern Europe are going to come about. So I think everybody's in our boat. What can we find in Nevada? What can we find in Western Australia? In the topic of this panel, what's the current COVID world look like? Looks like really, really safe places that are already in production or close to being in production, as opposed to going in the middle of the jungle and drilling out a resource.
Yep, certainly. But Chris, David, you probably, presumably both of you got partners on the ground in certain locations where you can leverage insight, quality of information, due diligence within projects that you have been looking at. It's not all completely flat. You're sort of stacking up the due diligence in preparation for things to open up, right?
Yeah, absolutely. From our perspective, we do that, in any case. So our analysts are busily, as I said, stacking up the projects that we really want to have a look at. We're in contact with those people in those regions. And the first opportunity we can get to get out there and actually see them or walk around the ground, we'll do that. But, we try and put as much effort as we can and leading up to that point, if we were to do a deal outside of Australia, in making sure that we can tick as many boxes as we can without actually getting there. I think one of the problems we've actually got, which is a good problem in a way in Western Australia, the fact that we don't have any COVID cases really currently, there's been no community spread for 200 days, is that we're actually not allowed to leave our state. We're locked in, and others are locked out. And so, as much as we want to go and we want to go and see these and we potentially take a risk for that, we actually can't.
Yep, understood. Karr, how's the view from Denver at the moment?
Yeah, well, Denver would like to say everything's fine and rosy, but to just echo Chris and David's comments in part, I mean, for our business, we see the COVID issue impacting it in a number of ways, and we're still seeing other COVID related reactions to opportunity and how it's approached, but it certainly complicates the playing field for us. I mean, we have in our firm limited capital to deploy at this point in time, so we're highly reliant on in effect, arranging transactions and bringing in co-investors. So that's always a big issue. We're also more focused on credit than equity, so that pushes us in a certain direction as well. I think on the credit side of the spectrum, for private capital investors in particular, it's very difficult because due diligence and your reliance on cash flow and evaluating the certainty of cash flow and how you respond to opportunity and structure deals is very important. So clearly that's all backed up. You can't access people, you can't access sites. You can't do it with consistency. So it takes certainly a lot more time. It also pushes the way in which you try to structure and mitigate risk in certain directions, which I would just say invariably leads to a higher cost of capital. For any one situation, today, rather than what you might see in a non-COVID, world. So there are a lot of things, well beyond our control, our clients' control, and even the markets, for that matter, which complicate things. So decision-making process is stretched out. So there's more fixed costs centered around trying to execute. And it's definitely difficult. And as time goes on, there are lags and lapses in acquiring and confirming, new data and information. So it's a difficult playing field. But having said that, private capital pools have to put money to work, and so it's not like there aren't willing investors. It's just trying to find that practical mode for execution, which has been a challenge for us.
Yeah, excellent. Some good points you touched on there, Karr, that I'd like to come back into. But just before we delve into some of those, I'll bring Neil in. Neil, how's the view from IFC? Towards the situation right now, and are you experiencing some of the similar challenges, circumstantial challenges that we've heard from our co-panelists here?
Yeah, it's incredibly challenging. It's been a difficult year. And just in keeping with our role, we invest in developing countries and jurisdictions around the world, and it's not easy to get in and out of country, not just for us, but even for project teams. So that's particularly challenging. But on the plus side, I suppose, in keeping with our role, we're trying to foster investment and development in developing countries, and so we're actively trying to support projects. In terms of our strategy, we've in the last 5 years or so, we've moved almost exclusively to later stage projects, which means debt financing, typically classical project finance. And there are lots of reasons for that, but I think what we're seeing now is there's probably a renewed need for equity investment, and that's something we can do and would look at selectively. As to how we're operating, I think first off was looking at existing clients and how we can help them, because it's obviously easier without the need to go to site, for example. And so, can we make additional financing available? For example, if it's related to COVID and companies are facing challenges. So we've done that in a number of places. And possibly new facilities or extending the term of investments, and that's just to create more breathing room and capacity for companies. So a lot of focus on our existing clients and how can we support them. In terms of new business, that's obviously more challenging. There's a need to be on the ground. Our value add is engaging with the government, and here we're trying to use our local offices. We have something like 50 or 60 offices around the world. And so we use teams in country to engage with government, because that's really our value add, or part of our value add. The other piece is, environmental and social supervision. We're very focused on sustainability. How do you do that? And it's using local consultants there as much as we can. The last piece is, social license to operate, engaging with local communities, trying to help de-risk projects. And that's really challenging because you need to be on the ground, and we're not. But there we're hoping that, we're working with our clients who are of like mind and trying to support the local communities in the area that they operate. So that's where we are.
Yeah, certainly. Okay, let's come on to some of those ESG points a bit later, because I want to raise that as a separate topic. But Neil, just in general, my understanding is that the IMF and governments are looking to put more capital into infrastructure-led and certainly mining-led projects, if you like, as an infrastructure-led recovery globally, and also in emerging markets, as you mentioned, that will need this development capital to stop economies from stagnating or falling into a worse condition. So, as far as I understand, the capital is available. Would you agree that, capital for projects is there in the capacity to lend? And it's interesting you talk about the equity now as well. It's just these physical barriers that are slowing down the whole process. Is that a fair assumption?
Yeah, I think absolutely. You said it very, very well. And, infrastructure development is a huge focus for us. If we can use a mine as an anchor to develop infrastructure, be it transport or power or even water in some cases, that's a big plus. And you find a willing partner in government, which, is capital constrained to finance these pieces of infrastructure. And so if you're able to broker a good solution or even a multi-user solution where you can bring several parties together, that's a win-win for everybody, and that's something we're really trying to focus on around mines, around operating mines.
Yep, certainly. Okay, well, let's sort of consider amongst the panel mining in general. We've got a gold bull market that's going underway. There certainly seems to be renewed interest, perhaps from generalists in the sort of top tier. Valuations are shooting up, as we've heard, for certain mining companies. This is presumably a buoyant or relatively positive time for mining when we consider what's going on globally. Does anyone have a sort of comment on how positive is mining at the moment beyond this sort of restrictive COVID, lack of travel kind of environment? Would anyone like to tackle mining in general?
Yeah, I'll try. I don't think your average capital allocator would rather buy an ETF or maybe a gold index fund, or a Van Eck or one of those type of products before they would say, yeah, I'll put 20 million bucks into this redevelopment of this asset, or 100 million bucks into one of these mining funds like a Lascaux. So I don't think you're seeing the generalists saying, yeah, no, the mining's the place to be. I think the valuations are fair to maybe too high for the majors, and that's the only place they can really play, the large allocators. And so, I don't think you're seeing the generalists coming back to the mining space as you probably would have thought was happening. I think most of the equity capital markets were open for mining companies for the last 12 months, which has been great. It was really the air that they needed to sort of develop projects and build the pipeline back up. But I don't see this wave of capital that already wasn't allocated to mining coming into the space. I don't. Maybe I'm a pessimist and I've been seeing too many cycles, but it doesn't feel like it's mining rah 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 forever right now.
Yeah, certainly. But gold certainly got generalist interest. Would you agree with that, or is it more a case of pension funds sort of waiting to move, and then that might trickle in more generalist capital that's slower to move?
Yeah, no, I think that's fair, and I think gold in particular it does have that interest. But I mean, a lot of people are doing that in passive vehicles. You're not seeing allocations to specific names at this point.
Yeah, certainly. Anyone else want to comment on some of the points touched on there?
Please,
go
Neil.
ahead, Karr.
Well, yeah, I'd just say quickly, I think, David's right. It's, there is interest, obviously a lot of investment and return expectations are driven by, metals prices, minerals prices, if you will. And so that, that's a factor that's supportive, but, we have found it challenging and difficult because of, with investors, because of jurisdictional concerns, in particular, COVID in general. I mean, we see, again, coming back to this decision-making process, and my experience through too many cycles now, we see institutions sort of, step back and focus on existing clients and key markets, and during times of crisis and uncertainty. And even if you have some momentum on a particular transaction, that can change very, very quickly. So I think what's been interesting for us is to see some opportunity on the periphery, which again, in some respects, is tied to some of the comments Neil was making with respect to infrastructure. So we're looking at past sponsors having to deal with reclamation liability today in a higher price environment. So we're seeing just retreatment of material, either low grade or tails, or the repurposing of industrial waste that was generated by mineral products, into construction materials and other factors, which is interesting because it fits in and addresses a lot of diverse stakeholders' requirements. Again, I don't want to get ahead of you, Adam, but tied into ESG, circular economy, sustainability themes. So that's kind of a trend that we've seen and that we've been successful, sorting through at this particular time. So it's again, and I think part of the reason for that is that it's difficult. I think when people are trying to put projections together to have a lot of confidence in, either the capital or operating costs, not to mention minerals prices.
Yeah, certainly. Neil, you were do you want anything to add to anything?
Yeah. I was just going to say, I think we've seen a slowdown in exploration spend. And then on the production side, we've seen constraints across the globe where companies have had to restrict supply. And then we've got, dynamics with different countries coming back online at different speeds. But put that all together, I think it suggests that the fundamentals for demand are fairly good. And so you'd expect a longer term pickup in prices. So coming back to your original question, which was the investment side, I think, there is a good opportunity and good opportunities in the market, but you have to be prepared for a long-term hold. I don't think it's going to be a super quick recovery. And that's where, generalist investors might be challenged because they're not willing to wait out the time you'd require to see that recovery.
Yep.
Yeah, I'd just like to add on that, Neil. I think as a generalist, straight equity investor into the market, I think you're right. It is going to be quite difficult because, particularly in the gold space, some of these valuations are unrealistic in some of these companies. And whilst the mood is very buoyant, and particularly here in Western Australia, when they had the conference in Kalgoorlie just recently, there was a very good mood there. But ultimately, a lot of those players in that market are junior explorers, and they don't actually make any money. And the benefit of an increased gold price for them is really just another chance to raise more money. But ultimately for them, all that can really do is add a few exploration dollars to their kitty and potentially look for new greenfields. So that's a good benefit of that. They can use that money for greenfields exploration, and they're going to be, our expectations are going to be a few other pretty good discoveries out there. But on the flip side, these valuations on the bigger companies is going to allow them from their balance sheet to raise money a lot more cheaply, and actually use that money to increase sort of M&A activity on some of these smaller companies, these smaller exploration companies or producers, and add ounces to their inventory. And so, that, I guess that's another benefit. But from our perspective, we think this, the increase in the gold price, particularly for our project in Africa, is significant for the regions, and as in the space where you operate in these developing countries, where there's the increase in gold price, it makes these projects that are economic, it makes them actually more economic, a lot more attractive, easier to fund. And when these projects can get up and running in these countries and in regions that are actually have no infrastructure there, it's a significant game change. It's transformational for these areas. And for example, in Ghana, we're about to start production or start construction of a mine out there, and this is going to develop $1 billion worth of funds flowing into that region that they would not have seen before. So I think we were lucky in the fact that we're at that right point, that right time. But COVID, we're able to have the people on the ground there. But I think there's mining can have a good impact, particularly when you're in the in spaces like now.
Yeah, certainly. So with these sort of spiking valuations, as alternative lenders, do you find the space is becoming more competitive, perhaps, when you're looking at new projects or new companies?
I think the equity availability has actually helped us in the lending world because, as Chris was saying, exploration budgets are now getting funded. There were probably, I don't know if y'all had the same experience, but Beaver Creek, I had 20 different meetings where guys said, by next year, we're going to have a new resource, or we're going to have a feasibility study. So there's those dollars that weren't being developed into the pipeline came from the equity market, and those things are happening. So you can see, 2 years ago, I would have said the same conference, I didn't see any projects I thought were worthwhile, right? It's the same stuff I'd seen it a million times. As a lender, it didn't look appealing. Now you're seeing stuff getting funded, and the next wave of potential new projects is out there. So for a lender, I think there's a bigger amount of possible lending activity that we can do. And I do believe, everyone has a fund the same vintage as ours, had a pretty terrible track record, right? Because prices tanked as soon as we got funded up and we're looking at projects, and so either the projects themselves weren't very good, management wasn't good, or just the price wasn't cooperative. So I think there's a lot of there's not many lenders, and there's a lot of projects. So I think it's not that competitive anymore in terms of we're not fighting over deals, and it's it's a question of whether or not, as Karr was saying, there's people are even going to allocate capital to space. That's the biggest question, I think. But there's no shortage of new projects that look fairly interesting right now.
Okay, certainly. Okay, well, maybe we'll hone down then into some of the triggers or the areas, and then bring in some of what Karr was raising around ESG in terms of what you need to see from projects. How are ESG developments evolving, perhaps, whereby you take that into a meeting with a new company or with a prospective company of interest. And how does that specifically work for the alternative finance provider rather than a straight equities investor, for instance? Anyone want to tackle that? Karr, maybe you had some points on it earlier.
Yeah, well, I'll just start out. I mean, as David has alluded to, and even Neil and Chris in part, I mean, the playing field's evolving, quite a bit. Certainly earlier in my career, if you were in the extractive industries, there was a pretty, tight algorithm for raising capital and how you would access it and whatnot and so forth. And that's really been turned upside down, in part driven by the exit due to either the 2008 or 9 financial crisis, or carrying through to COVID today. The commercial bank market has really stepped back. In many respects, it's one of the reasons why our firm is come together, and we see ourselves as filling that commercial bank void in particular. Some new projects, some new products, capital products such as streaming, have stepped to the forefront. That can wear both equity and debt hats, if you will. But I think a challenge is there's oftentimes no one source of capital that can address the entire requirement of a new project development today, where scale is typically an issue, isolation, infrastructure requirements, as Neil was pertaining to. It's really challenging. So when you come back to look at ESG concerns, they tend to rise early in the consideration, and people want to tick that box in a much more sincere manner today than perhaps they had before. And if you're a large private capital pool reliant on a number of LPs, they typically have policies in place that they're paying attention to, that their stakeholders are paying attention to. So there's a lot of bottom-up incentive and momentum for companies to address these broader stakeholder issues early on in the game, rather than deal with them as they arise, through a project's development.
Yeah, and within those, can we hone in on those, and perhaps more specifically, are there any that you think are perhaps harder to track, or maybe companies are doing particularly well on the environmental side, but not on such others as such, or maybe the COVID overlay, the social and community impacts are harder to manage?
Yeah, well, I believe today, in particular, with resource allocation issues, human resource allocation issues, yeah, there's a big issue with due diligence and maintenance, and that in part entails regulatory authorities that are involved. I mean, people can't access isolated sites effectively because they're either not willing to travel, or there are restrictions in place by the sponsors, which limit outsiders from penetrating a bubble, if you will. So it's pretty complicated mix of static out there, I believe, today. So it's hard for someone to tick the box simply because they can't complete with confidence the level of diligence that they would normally be able to do. And in particular, if you're resource light in the area of focus, then that is that's a real limiting factor for people. It may take them a while to understand that, but so they may pursue an opportunity to a point, but when it gets to the point where they're having a lot of trouble with the precise visibility they want around these issues, then the brakes get put on and people step back and decisions aren't being made. So that's based on our experience throughout the year, those comments.
Yep, certainly. Anyone else want to add a little bit more on what your experiences are with the harder to track elements maybe of ESG, certainly at the moment when you're meeting companies?
Yeah, that's we've always, I guess, as mining investors, focused on the environmental side because you need your permits and you got to be in track. So it's, I think in general that's easiest to track. Now you still might run afoul and make mistakes, but you at least know that all the paperwork's in place, all the government authorities have signed off, and the plan has been approved, right? And so it's just the cost of what it's going to be to keep that monitored and the rest. But I think it's the S&G part that's gotten really tricky now. Particularly as Karr said, you can't go to site and hang out and get a feel for what's going on. There's no local bars anymore. All that stuff's gone. So you really can't get a pulse of how the mining town's doing, how they're treating their employees. What if someone says, "Oh, the air quality's crap," it's not true what they're telling you. You can't have those conversations anymore. So that's a problem. And I think you're seeing a lot of jurisdictions coming up in mining where it hasn't been tested at all, right? What is government's role? What's the tax program going to be? Ecuador has billions of dollars worth of companies that have deposits, none of which are in production today. How's that going to look 10 years from now, right? We saw what happened in Colombia, right? It hasn't been the huge success story that everyone thought it was. Minerally extremely rich, but in terms of production levels and tax flows going to the country, not so good, right? So I think the E we kind of have our arms around, but the S&G, I think under COVID in particular, is very difficult, right, to track.
Yep, certainly.
I couldn't agree more. I think maybe it's because of technology or social media, but I think the community issues have become much more significant and now. Having said that, I think for the same reasons, technology, social media, maybe there's some ways to manage these better. And the countries you mentioned, Ecuador, Colombia, we see lots of social activism there opposed to projects, for example. So could companies engage in a better way? And I think the answer is yes. And it's relatively simple things, particularly when we talked about equity, which usually comes in earlier in the investment stage. Your footprint is smaller and the issues are easier to manage. But it's things like expectations management, where communities may not necessarily distinguish between exploration and production, but you're on the ground, they see you, and they have expectations. And an effective communication strategy, which might be managed from distance, could help to mitigate some of those risks. The other difficult challenge, I think, to measure is things like a lot of countries now have revenues which are paid to local communities as well, and that's particularly difficult for the company because they're not part of that process. They pay their royalties, they pay their taxes. But if the money doesn't flow back to the local community or it's not managed effectively at the local community level, the communities get upset with the mining company who's really not, they have no control over this. So how do you manage these kind of complicated issues with so many participants? And I think early engagement, constructive dialogue, communication strategy. I think sometimes that the cheapest investment a company can make is having an effective communication strategy to really talk to their constituents and stakeholders and help people understand the issues. And it's hard to do in a COVID world, but I think it's probably easier than actually than managing the operations. So why not focus on some of these softer issues? That's my 2 cents.
Yeah, certainly. Neil, I'm thinking more about commodities of focus then, and some of the protocol that you'll have at the IFC. What commodities are you sort of focusing on now? Are you able to look across the whole battery metals complex? Are there certain issues around cobalt, for instance, if that has some of these ESG risks, particularly prevalent around certain jurisdictions for cobalt mining? Does that restrict what types of projects you can look at?
Let me start with the last part of your question. The only 2 commodities we are not involved in is coal because of climate change, yep, and uranium. Other than that, we can pretty much look at everything, and we do. Commodities we like is anything that's linked to a low carbon future. So copper, because it goes into electrification. Cobalt, we're very keen, but frankly, cobalt is a byproduct of copper.
Chris, you've got Western Australia ticking over in a sort of bubble in its own way, so you could feasibly do all of the necessary due diligence, ESG work around projects there that you already touched on. Is that then going to be the focus while we have these restrictive conditions, or is it a case of sort of looking where you can and then waiting for all of the wider regions to open up and start working through that backlog? And are you looking at new projects within that region as a result?
Yeah, look, that's a good question. I think with the ESG point, as Neil was mentioning before, we are equity investors primarily and solely, and where we invest in the space is early stage, and so from our perspective, those issues, those ESG issues, as Neil was mentioning before, are relatively early stage as well. And so we make an effort, particularly when we start projects, when we actually get into the projects, is to ensure that we actually have a program of installing and understanding and actually building out those programs internally within the projects we set up from the very beginning. We engage with our communities very actively. We make sure that they understand what we're doing, why we're doing it, how it's going to benefit them. 90% of the staff within both the projects are all local. We only really bring in our project guys, our partners to manage some of the more technical aspects of it, but we make sure that everything is worked down towards the local communities, and we absolutely engage with them in every aspect of what we do. But part of what we do is really, when we exit our positions, we're exiting to companies who socially are getting lots of pressure from their shareholders and their stakeholders as well. So they're not going to touch any of these projects unless they have those boxes ticked. And I don't really like that term, ticking a box for ESG, because I think all of us have a social responsibility, really, just in everything we do, not just in the mining space, but everything, is to be thinking about these issues. And certainly we don't go anywhere near projects, even no matter how good the project looks and how good the economics are, if it's in a region where people are being displaced or not being treated fairly, or the money is disappearing, or the corruption is out of control. We won't even go there. So I just think from going overseas, yes, we are looking for all those projects, and we have got a number of them listed, but a lot of them we have to filter out because of those regions. Really good economic projects that can make lots of money, but we just won't go there. In terms of going back to your question on Western Australia, I think we have fallen under the spell of the gold valuation. So a lot of the projects, they're overvalued. I think we're quite lucky here in that ESG as a process, and the impact investing as a process is very well ingrained, particularly locally. I can't say that too much about our international a large international company like who made a bit of an error up in the northwest just recently. But the ESG component is it's just standard procedure here. This is sort of for a lot of these sort of first world issues that are being regulated and have been regulated for a long time. So for us, it's not an issue in Western Australia, but when we work overseas, it's something we actually install specifically and build out. And the partners we use are all first world partners who have that as again ingrained. So we ensure that those layer upon layer of ESG thought process and procedures and policies are there.
Certainly. And just within that, do you think there's any areas that you would like to see the miners improving on within the ESG, or maybe you're not, the data could be provided could be better, or there's an area that you think needs more focus? As you say, the environmental side has been championed a lot in the headlines and around mining, but what about the junior tier? Is there a particular area that they can brush up on maybe?
Yeah, I think to the point made earlier, I think the social aspect of it, I think is super important. I think if you don't actually get that correct and you don't focus on that, you're going to have problems all the way down the line. The people, the communities you're working with, they have to be engaged in the project. You just can't fly in, and dig up their backyard and and then fly off with all of their money. Like, that's just not right. And so you've got to be engaging with these people at a very early stage and be making sure that they're part of the process, because it's, you're making money for your investors and for yourself based on what they have. So it's, it's your responsibility to do that. And in terms of the governance, well, you can install governance internally within your own procedures and your own processes. Actually bringing that governance and to sort of a more of a macro view in a particular country is potentially harder. So you just got to make sure that you govern your project and your people the way that you should be governing them, and as much as you can within those governments that you're working with. And most of them are very good, and some of them aren't, and some of them are very good, but there are certain people in some of those governments who aren't. And you've just got to make sure that you tread very carefully and you use the right people to ensure that you're not, not doing the right thing, and making sure that you're covering and making sure that you're doing the right thing for your investors as well as the people on the ground there.
Absolutely, yep. Linking those two sides very carefully and well balanced. Okay, great. Well, look, gents, we've covered a lot of ground, and I think we'll just wrap up with a sort of thought towards 2021, assuming that travel restrictions can ease up and conditions for getting out to sites and getting around improves, and that is a big assumption in itself. So perhaps forward-looking statements here. But assuming that happens, how do we see the lending environment changing or improving? And then, Chris, I'll put it to you as an equities investor, not so much on the lending side as well. Would anyone like to tackle that? So thoughts on next year, please.
Sure, Adam, I'll just chime in. I mean, clearly macroeconomic factors will play a big role. We're sort of all existing in a stimulus-fed bubble of sorts currently, and it's really going to be difficult to understand how more localized economies are weaned from that background, and that will simply have a very large bearing on how things develop going forward. But clearly, I think for these capital intensive industries will be challenged. They need that price carrot out in front of them to sustain the investment initiative that's required to fund these long-term assets. So it won't be easy. I think it's really hard to predict how things will play out and the timing, but there will be some very unique challenges in trying to move forward as we go into 2021, and hopefully the COVID pandemic is being addressed more effectively by developing vaccines and treatment and testing and education.
Certainly. David, do you have any other thoughts to add to that for 2021?
That was pretty good. I would add, as part of that macro picture, we've got an election here in the U.S. You got Brexit. Where does the dollar go, right? Because all of our favorite commodities are priced in the almighty dollar. The almighty dollar's been super strong. Is that the case going forward? How much are we going to get trillions of more dollars pumped into the economy to prop it back up? If the dollar could finally fade just a little bit, that would really balance out metals prices for the future. And so that would make it a very good investing environment, whether that's equity or debt dollars into mining projects. And so I think that's the biggest question on my mind, with or without COVID, will there be more loose dollars going into the world and propping up what's left of our economy, which would then weaken the dollar finally and let these mining projects make a fat margin going forward, which makes them very investable. So that's the biggest question for me. Without that, I think it's going to be very challenging. I think you'll see margin compression, and I think mining will become a very challenging place.
Yep, excellent point there. Neil, do you have a view on the dollar or on any other macro thoughts for next year?
No, it's not really. It's not really my area of expertise, frankly. I mean, I think we'd look to invest in counter-cyclical markets. So whether the dollar is overvalued or strong versus other currencies, it wouldn't affect our approach to business. We continue to look for strong project fundamentals and clients of like minds that we can support their projects. I think what we are seeing is clients are looking to reduce capex or become more capital efficient, or spread out the capex over a longer term, which makes it a lot easier for financing. Obviously, smaller risk and better coverage ratios. And I think on the funding side, as far as debt goes, I think a lot of banks have been holding back and have capacity. Obviously, they're concerned about risks, but at the same time, good projects will get funded.
Yep, absolutely. Chris, just wrap us up with the private equity view there of how you see 2021 prospects, perhaps on the macro side or otherwise.
Yeah, a little bit like Neil, we're not predictors of the future in terms of commodity pricing or dollar values or interest rates. And I think what we can all probably agree is that each of those is going to be pretty volatile next year. Our expectation of funding and the lending into that market, the banks are tightening, and we've been spoken to quite a number of banks about various different things. We contact them all the time and chat to them how they're doing, and we've spoken to a couple of banks who are looking to, they're funding gold prices, and they are, they're running their models at a gold price of like $1,100. Which is remarkable, given that's almost 50% discount to the current market price. And if you're finding good projects like Neil is saying, people will lend, fund into them, but predominantly that's going to be an equity funding. For us, that's great. We can find those good projects that aren't overvalued. We're happy to fund into those from an equity perspective. But I don't think that's just the single point of funding. I think there is a space for debt in terms of maybe some sort of convert or debt as a component of equity with us as a complement. But our space is not really a debt space, given that we don't produce any income revenue from our investments until we exit. So it's not really the place to play. But the banks we speak with, they want to lend. All the guys we speak to want to lend, but the guys at the top don't want to do it at all. And the margins they're making are pretty small, because they're competing against some of these bigger government fundings. There's ECA groups that they're giving money at less than 3%, less than 2%, for these battery projects, environmentally sustainable projects, and the banks can't actually compete with that. So it's going to be a strange old world next year.
Yeah, and just on your point on exits, then, do you think the environment's still good and buoyant for that exits next year with the companies that you hold in your portfolio, for instance, or where you like to exit a company?
Yeah, look, I think there's lots of people in the industry, particularly within the space of, we currently hold two gold projects, and we like the copper. We like some of what future facing commodities. We only look at those that can help help I guess sustainable environment going forward. But I guess we don't look to be building tier one projects where there's like 8 investors who can buy the project, right? So we look for projects where there are investors who can add ounces to their inventory, who it's a complementary asset to an existing asset. The pricing isn't outside of their balance sheet. So we certainly do see interest. But again, the actual groups out there are becoming, there are less and less of them to do that. And they are becoming conservative themselves, and they're being very careful with what they see as a decent project. So, and all the way through the chain, it's not as easy as it was.
Yep. Certainly. Okay, well, look, we've covered a lot of ground. Thank you very much, everyone. Plenty of challenges ahead, but plenty of opportunities there, I think I sense from some of the points that we've covered in the discussion. So, gentlemen, thanks very much for joining me at 1-to-1 Mining Investment America's virtual session on mining finance, and thanks for your time and expertise. Take care.
Thank you.
Thanks, Adam.
Thanks.